I made a post at the end of last year and it absolutely lit people on fire when I told them, hey, you could buy this horse that we had for sale and you could write it off on your taxes. And so many people wanted to give me every excuse as to why it wasn't possible. And that's what we're going to get in today's video, is the critical mistake that I made very early on in my career that had exactly to do with taxes and buying horses. And I'm going to share with you a 4-step process that we use today to keep these issues from arising to where we don't get caught by surprise, let's say. It is always the things that you least expect. And one of the things that I never expected in all of the time that I put into creating content for people is people that would get mad, horse people that would get mad when you told them that they could buy a horse as a tax write-off and then they could have more horses. And there was only like 20% of people that were like, that's the best news ever, right? And of course, the post was made in a half-joking way. But at the end of the day, there were a few professionals that did comment on this, and it brought up a much deeper lesson, because in fact, there are times where you can purchase horses or you can purchase things that benefit you in a tax way, right? There are times where you can buy a horse and it can save you money on your taxes. And if you're new here, really quickly, my name is Colton Woods. I want to welcome you. I want to say very thankful to have you here, because I'm here to share with you the exact strategies, tactics, tips, approaches in horse training and in horse business development that helped me go from a life far, far, far away from horses to building a highly successful horse business that has been built on high quality horsemanship and on sound business strategies. Along the journey, I've never had time because I got a late start, but also just never had time for the BS fluff that so many trainers waste time teaching to their students. And there are so many broken business models and mindsets within the horse industry that, frankly, as far as I'm concerned, need to die. So these videos are my effort in sharing high quality horsemanship and horse business knowledge that can help you as a professional, so together we can make this industry a better place for future generations. Now, let's get into today's video. It doesn't matter what stage of your business you're in. One of the things that I think all of us can agree on, and maybe you can let me know in the comments if you agree with me here, is no one likes paying taxes, right? No one likes paying taxes. In fact, one of the things that I used to tell myself, my cousin served in the Air Force, and every time I had to write a fat check to Uncle Sam, I always just imagined that it went to his salary. That was like the way that I could pacify my anger for having to pay the government. And I'm not opposed to paying taxes and paying my fair share. I definitely think that that is necessary. But I don't believe that we should ever have to pay more than we need to, right? And that's where there is a tax system where when we learn how the system works, whether that's that we go learn how it works or we hire someone that knows how it works, that we still pay our fair share, but we don't need to pay any more than that. And we'll jump right into what that critical mistake, because early on in my horse business, I was strictly training horses. But I will tell you that my kryptonite in the industry, the fastest way that I love setting money on fire is breeding horses. And I still love the process of breeding horses. Why do I love breeding horses? Because I love the process of going from the thought of matching mares and stallions to bringing to the excitement of that foal hitting the ground and hoping that it will be a quality horse, because there's a level of hoping and wishing and luck that is involved in breeding horses. So early on in my efforts to reduce my tax liability and not pay any taxes, because that was what was on my radar, was I'm not going to pay any tax. I don't want to pay any taxes. My tax strategy was, without consulting my tax professional, buying horses, right? Buying brood mares, buying a stallion, and starting that dream of having a high quality breeding program and investing in my business. Now, investing in your business and building your dream and being able to use what we call your core offer, which is your main primary source of income or service that you offer through your business, is a fantastic idea. But that's another discussion for another video. However, how you go about doing that is really, really, really important. And What I did know at the time of buying these horses was that I could in fact write them 100% off on my taxes. I knew that they would be 100% tax deductible because I had no intentions of selling these horses. These horses were not sales horses. These horses were brood mares and a stallion that were going to remain part of our herd forever, right? That was the vision and the idea. What I did not understand though was that, let's say that things change in a business and then I decided that I was going to sell them 6 months, 12 months, 18 months, 36 months down the road, that I would then have to go back and pay the taxes on those horses because I did not keep them for the full depreciation period that they would be depreciated over had I not wrote them 100% off on my taxes. And so to break that down really quickly, normally if you have something that you can write off 100% on your taxes, you have the option of taking the full write-off up front or depreciating it over a period of years that is set by the tax code. And breeding horses is no different. Same thing with a vehicle. And then there's all sorts of stuff, right, that we can write off on our taxes. And let's say that a horse was depreciated over 5 years and you sell that horse in year 2, you would owe back those taxes, that depreciated money that you wrote off when you first bought the horse because you sold the horse before the full depreciation period was over. And that is exactly what I did not quite understand about the process. And the other thing to keep in mind is that not everything is 100% tax deductible. And that's something that's very, very important to have in mind when you're going into making these investments to reduce your tax liability. So let's say that, for example, a real life example, that your tax liability was $10,000. And in order to reduce that tax liability, you went out and made purchases, investments in your business of $10,000. But you forgot the fact that not everything is 100% tax deductible. Here's the problem, and this is the mistake that I made very early on, and I want you to learn from it. And I'm going to share with you a 4-step process that we use today to keep these issues from arising to where we don't get caught by surprise, let's say. And so we look at the fact that we have a $10,000 tax liability and we go out and we're saying, you know what, to get rid of that $10,000 tax liability, on a very kindergarten level, we could say, let's go spend $10,000 on things that I would rather have, because guess what? I'm going to write a check to Uncle Sam, right? I'm going to write Uncle Sam a $10,000 check, so I have a choice to make. I can write Uncle Sam a $10,000 check, or I can go spend $10,000 in my business on the things that I would rather have, and then I don't have to pay taxes on that, right? That's what I was thinking, okay? And so that's what Colton went out and did. But what happens when we don't understand that not everything is equal in tax deductions across the board? You go out there and you spend that $10,000, and then you turn your books over to your tax professional, and your tax professional so kindly informs you that you have $3,000 of deductions. And you're like, excuse me, I just went and spent $10,000. How do I only have $3,000 in tax deductions? And they explain to you that it's not a dollar for dollar ratio on the things that you decided to purchase. And certainly some things can be fully depreciated, but at the end of the day, you have $3,000 of that can be depreciated on your taxes. So you've gone and spent $10,000, you were able to write off $3,000, and you still owe the government $7,000 in taxes because your original tax liability was $10,000. So you went and spent $10,000 to offset that, only to offset $3,000. And now you still owe the government $7,000. So all of that comes down to the fact that we have now spent $17,000 to try to avoid a $10,000 tax liability. I'm not saying that you should just roll over, play dead, give up, and just write the check and cry your way to the bank and just be like, there's nothing I can do about it. There is. It's called learning the tax system and playing the game. Business, to those that are most successful, look at it as a game. And it's about understanding how the game is played. And here in the United States, this country is built for entrepreneurship. It's built for capitalism. It's built for you to be able to achieve the goals and the dreams that you have through your business. But you have to understand how to play the game. And so when it comes down to taxes, it's about understanding that system. I'm going to share with you the 4-step process that we use to make sure we don't make those same mistakes that I made, because it was a very kindergarten level mistake, but it was a mistake that I made early on out of the emotions of avoiding paying taxes to a government or to a system that I don't believe does a very good job at spending money, right? Many of us, maybe you can agree with that our government doesn't do a very good job at managing money. So for people that as entrepreneurs, as horse business owners, when we work so hard to earn the money that we do earn, it is really tough to hand that over to an organization, to an entity that does not manage it well, okay? And we have to understand is that there's a system in place for us to be able to retain as much as we can, utilize the money within our business as much as we can, but we do not want to get caught up in avoiding taxes on the emotional level to the extent that it actually hurts us financially, right? Because as I just explained, to go out and spend $17,000 to avoid a $10,000 tax bill, that point in my business was absolutely almost catastrophic because I was not making that much money, okay? Yes, I made enough money to have a $10,000 tax bill, but at the end of the day, it was not, the business wasn't just prospering at that point. So let's dive into the 4-step simple process that I'm going to share with you. And we're going to keep this pretty high level at this point. And if you want a more in-depth video on this, let me know in the comments down below. So the very first step in this process is planning ahead. And we start planning ahead for our taxes about August or September. And that means that at about August or September is when I start to reach out to my tax professional and I say, hey, this is what our year to date looks like. This is what we've done in business from January up until August or September based on when we're having that conversation. And then we also share some projections of like what we think September, October, November, December is going to look like in the business. And we can start to have that conversation of what our taxes might look like based on what's already happened in the year and also what we expect to happen for the rest of the year, right? And this gives us plenty of time when we start having these conversations in August or September to plan ahead for our tax strategy, because at the end of the day, we have to have all those decisions and be able to be done executing on everything before the end of the year. And we don't want to be rushed in these decisions. So we strategically start having these conversations in August or September, which to many people might feel like way early because you might be doing your taxes in March or April of the year that they're due. But at that point, there's very little that you can do to affect your business on your taxes. You're kind of just stuck with where you're at based on how things ended December 31st. And you don't want to be stuck in that position. You want to plan ahead because the 7 P's, right? Like prior planning prevents piss poor performance. Right? And that's where we come in at this first step of planning ahead in August or September. Step number 2 is we do what we call a look-alike tax assessment. Now, I'm pretty sure that's what my tax accountant refers to it as. If it's called something else, I'll put it on the screen. But basically how that works is that we go in and we take the numbers that we have year to date and we can put in some projections for the rest of the year. And we can get a simulation of what we think our tax liability is going to look like for that calendar year. And then within that, within the lookalike tax assessment, within this mock simulation that we're running, we can input different types of investments, different types of purchases that we could make before the end of the year and see exactly how it's going to affect our tax liability. And doing this can really help us make the best decisions for our business and for our family, because we already know what the tax outcome is going to be before we actually ever make any of those purchases, any of those investments, and any of those decisions, because we're merely running it through a simulator to see, hey, what happens if we do this? What happens if we invest this kind of money in this type of investment? What happens if we go and buy this truck at this price point for the business? What does that do to our tax implication? And that gives us the ability to make the best decisions possible. And guess what? We're able to make these decisions in clear mind, not emotional. We can make very logical, black and white decisions because we've given ourselves time to make these decisions, and we're using just black and white numbers, right? We're able to look at it for what it is. This is what our financial statement says, and this is what the implications will be of these types of investments. And we're able to have that conversation with a tax professional that can guide us along the way, right? These look-alike assessments are so, so valuable, but the only time that they're ever going to be valuable to you is if you actually plan ahead in your business for your taxes, which means that you go in there and you start having these conversations before the end of the year, and ideally well before the fourth quarter sets in. Step number 3 is what we refer to as strategic investments, and we've already done the look-alike assessment, so we know the implications of different types of investments, but now it comes down to what is going to be the best strategy, the best strategic investments that we can make. And for us personally, this really boils down to what is going to benefit our business the most and what is going to benefit our family the most. Because ultimately, we believe that your business should provide you the lifestyle that you want to be living, right? That lifestyle that you dream of, that you are working so hard for. Your business is the key to freedom. Your business is the keys to building that lifestyle, and it should work for you and allow you to do that. So when we get to that step number 3 of strategic investments, we are really, really taking into consideration what is going to be the best strategy from an investment standpoint to make sure that we are moving our business in the direction we want to go and moving our family in the direction that we want to go. Because we've already gone through the lookalike assessment, we already have an idea of what the tax implications can be. But now we're going to sit down and go through what is going to be the most beneficial. Is that going to be investing in a Roth IRA? Is that going to be purchasing equipment? Is that going to be doing a Section 179, which is the ability to be able to go write off a vehicle, whether it's a truck or a very heavy SUV for your business that falls under the tax code of Section 179, which can be, as in fact, exactly how I bought my last truck in 2021, I think it was, or I bought it at the end of 2020, and I was able to write that truck off 100% in that year because of Section 179, because I was, at the end of that year, I was looking at the options of either writing Uncle Sam a big fat check or being able to write off an entire truck on my taxes and keep that money within my business. And that was pretty much a no-brainer because the truck I had at the time was a piece of crap. And it was on its way out and the transmission was barely functioning. So buying a truck was not just a want or a tax advantage, it was a real need, and it really worked out well in the taxes. So the strategy in that was a no-brainer. It's like, hey, you need a truck, you really, really, really need a truck, and you can write it off 100%, and that's going to reduce your tax liability significantly, right? That was a way that we use Section 179. And there's other things such as purchasing horses, purchasing equipment, be able to invest in infrastructure like fencing or your arenas, or doing upgrades to your property that can all be taken into consideration when you do that tax assessment and you're looking at, well, what does my business actually need? What does my farm need? What would benefit my family and move things forward there? Maybe that's being able to invest in an education fund for your kids with reduced tax liability, all those sorts of things. So if we're really summing up that step number 3, we're taking what we already know factually is going to happen within the tax assessment, and then we're taking a personal look in step number 3 as into the strategic investments of what do we believe is really going to move the needle forward in the direction we want to go. Because guess what? There's a lot of ways to be able to get these deductions within your business. And you've got to pick the ones that you feel like you're going to work best for you. You're able to save money in write-offs in multiple ways, but you can't do it every way. You don't need to do it every way. You need to do it in the way that you really believe is going to move you in the direction you want to go. And that's really what step number 3 is for. Step number 4, this is where we execute. This is where we're executing on those investments and putting our plan into place. Now, remember, we started step number 1 of planning ahead in August or September, and now it's time to execute. This oftentimes will happen between October and November of when we've got the green light. And I really want to make sure that when I get the green light, that means that I have talked extensively with my tax professionals saying, hey, I want us to be very, very, very clear that this is what the numbers say. If I invest this much money in this way, if I go buy this piece of equipment, if I go buy this horse for this much money, that you're telling me on my taxes that this will happen. And I have those conversations multiple times because so many things get screwed up in just a miscommunication. And this is not an area where I want there to be a miscommunication. So I will make sure, and it could take 60 days of going back and forth and making decisions and figuring out how it's going to play out through your lookalike tax assessment, right? But we started in August or September, so we got time. And then usually for us in October, somewhere between mid-October, early November, we've got a green light of saying, let's go make these investments. And then at that point, right, we're able to move forward with investing money in certain areas, spending money on certain investments, whether that's building an indoor arena, redoing the footing in the arena, be able to build fence, be able to add on stalls in the barn, be able to buy a truck, like whatever the case is, right? There's so many ways that you can go about it. You can make donations, right? Another big way to get a tax write-off, but also be able to help others is to donate to nonprofits. Okay, well, how much could I write off this year? What organization could I give to make a difference in the lives of those people or those animals that they serve through a tax deduction of being able to donate money to them, and I get a tax deduction in return, and I can help a bunch of people or a bunch of animals in return. Those are all decisions that we make well in advance so that we can then give back, or we can go reinvest so that then, and ultimately, like, we reinvest in our business so that we can better serve our horses, we can better serve our clients, we can better serve our students at the higher level. And that's one of the most amazing things about entrepreneurship to me is like, yeah, you're making strategic investments so that you don't have to fork over as much money to Uncle Sam sometimes, but you're doing it so that you can better yourself, you can better your business, you can better your family. And therefore, when you do those things, you can better serve those around you and those that you're responsible for. And that is really what it's about. And so between middle of October, early November, we've got the green light, and then we're going to execute, buy the truck, buy the horses, donate the money, move money around between accounts to be able to make those IRA type investments or in kids education fund investment, those types of things. The last step there is we're going to execute. You got to have time to execute. Here's a really big thing to keep in mind. When you start having these conversations in August or September, by the time you get to November, your numbers are going to be updated. Okay, you're going to have your final numbers for August, your final numbers for September, your final numbers for October. And if you get to the 1st of November and then you're starting to get into that execution phase of your tax strategy, your tax account is going to be able to actually advise you much more accurately because they have 90 more days of factual, black and white, it is what it is, numbers for your business. And they can say, hey, yeah, we talked about doing this in August, but your numbers have changed. They're not exactly what we projected, and this is what we need to do instead. And guess what? You can make those changes on the fly. They're so valuable, but that's the only way that's possible is to plan ahead and to have those continual conversations leading up to the final time when it's time to actually execute. So the really big takeaway that I want you to walk away from this video, if I could hope and pray that you take one big takeaway from this video, is that it's not about avoiding taxes. That was the mistake that I made in the beginning, right? When I went and spent $10,000 to try to avoid that tax liability, but ended up costing me $17,000 at the end of the day, all within a couple of months. And that really put me in a pinch. Rather, what this is really about is being smart with your money and using it in the smartest way possible. At the end of the day, the number that matters the most is the number on the bottom line of your tax form, your profitability. Ego gets stuck at the top of the sheet, right? Wisdom looks at the bottom of the sheet. A lot of people want to see a big fat, I brought in this much money in my business. And that's not what matters. The money that matters is the money that you actually profited at the end of the year. And something that's really important to remember is that we have to remember that the tax code is the government's way of incentivizing certain behaviors that they want us to take. An easy example is look at all the tax deductions they did for hybridized type cars, electric cars. Why did they do so many tax incentives for people that were buying Teslas or Priuses or whatever? Why? Because they wanted to influence people's behavior and get people to go buy those vehicles because they think it's good for the environment. Okay, so they changed the tax code from year to year to change the behavior of people that are buying things. And when we understand that it's an incentivization system, it's our job to learn what are they incentivizing, learning the rules of the system, or hiring someone that knows that system really, really, really well. Every single year, we're able to lower our tax bill through making strategic investments. But the really important part to realize is that when we go to make these investments, we have pushed emotion aside and we are focused strictly on the logical numbers of they are what they are. And we have to remind ourselves that even when we still have to pay those taxes to Uncle Sam, that it's a good thing because that means that we're making money. And if you're interested in more tax type conversations and making money in horse business, I share in this video up here, wherever it ends up going, that how I went from completely broke in starting my horse training business to buying $1 million plus ranch in just 5 years. And in that, we specifically dive into how much taxes played a role and held us back. And then ultimately what we learned, first not being able to, but then being able to buy this ranch. And if you're sitting there thinking like, I really need to take my business to the next level and I'd like to get some help with it, you can book a free strategy session down in the link below where you can get on the phone with me and we will dive into what you got going on in your business and how we might be able to help you best be able to move your business in the direction that you'd like to go. But guys, I really appreciate y'all taking the time to watch this video and spend some time with me here. If you have suggestions or questions that you would like us to do future videos on, absolutely leave them in the comments down below because I use those to create video topics that we're putting out to be able to help y'all develop your horsemanship, your horse training abilities, as well as your horse businesses, because that's what I'm here to help you guys do best. And don't forget, check out that video.